2026, the biggest capital markets event of the year has finally arrived. SpaceX is going public. Some say this is the last chance for ordinary people to board the space economy arc. Others say it is just another century-old bubble wrapped in grand narratives. Told in 20 minutes, we will completely break down everything about the SpaceX IPO inside and out. ABS all-route monopoly, AI computing power, STARINK empire, and the 90 times price to sales ratio, $4.2 billion quarterly loss, $62.8 billion raised to repay debt. Is this a journey to the stars or a century-sized gamble? The answer may be more complex than you think. But before we dive deeper, we need to answer one question. Why has this IPO made global investors so frenzied? Keep in mind, SpaceX was founded 24 years ago in 2002. Over those 24 years, it went from a laughed-at pipe dream startup to the absolute dominant force in global aerospace. The Falcon rocket became reusable. Starlink satellites exceeded 7,000. The Crew Dragon sent astronauts to the ISS. More importantly, it proved the commercial space can be profitable, something previously unthinkable. So the 2026 IPO is seen by many as the last ticket in. Back before now, ordinary investors, LDNT buy SpaceX stock. It was always a private company. Its valuation soaring from $1 billion in 2010 to $1.8 trillion today. Airline employees and institutional investors have already made fortunes now. The door is finally open to retail investors, exciting, right? But excitement aside, think calmly, why now? Is Musk really trying to share the wealth? Or is the company burning cash so fast that it has no choice but to turn to public markets? I'll leave that question as a cliffhanger for ordinary investors. The SpaceX IPO is very much a double-edged sword, a potential opportunity to participate in the frontier of technology, but also a capital event with extremely high risk wrapped in grand narratives. While opinions are currently extremely polarized, INTERSTINGLY. Both bulls and bears agree on one thing: investing in SpaceX is essentially a vote of confidence in Elon Musk as an individual. So see who trust Musk believe he can turn Mars colonization into reality. So see who don't worry that his one-man empire could take the company in an uncontrollable direction. Next, we lay out the core logic of both sides one by one. You need to remember one conclusion up front. SpaceX company is great. SAT does not mean this stock is worth buying. Let us begin. Optimists believe this is not just buying an aerospace company but buying the future monopoly of space economy Y plus AI. Not either keyword. Monopoly. Why? First, the logic, absolute monopoly and vision premium. SpaceX dominates roughly 90% of the global commercial rocket launch market. You heard that right, 9 out of 10. Who are its competitors? Blue Origin, Rocket Lab, and some national space agencies combine ED. They have less than 10% market share. SAT level of dominance is extremely rare in any industry, and here is the scary part. This advantage is self-reinforcing. More launches, more data, better real elite, lower costs. Lower cost, more orders. A classic winner takes all loop plus Starlink is already the absolute leader in satellite internet. While LDNT is willing to pay a Musk premium. Some compare it to investing in railroads during the UST Rail or Amazon in the early internet era. But is that analogy valid? What do railroads and Amazon have in common? Both reshaped infrastructure, both created entirely new economic ecosystems. Both say SpaceX is doing the same thing, turning space from exclusive to nations into commercial infrastructure, allowing ordinary people to enjoy satellite communications, space travel, and even life on Mars in the future. The imagination space of this vision is something traditional valuation models cannot capture. Second, the new AI computing story. SpaceX might be the most surprising variable in this IPO. SpaceX Memphis data center has 220,000 NVIDIA GPU sets. To put that in perspective, that is one of the top 5 AI computing clusters globally. It has already signed massive AI computing lease agreements with Google and Anthropic. LDMA6 forecasts that by 2030, its AI-related revenue could reach $322 billion. Where does $322 billion mean? As it is more than twice the annual revenue of NVIDIA's entire data center business today. Of course, that is a 2030 forecast, but the key here is the number itself. It is the narrative shift. SpaceX is no longer just a rocket company. It is becoming a space plus AI dual-engine giant. In the 2026 capital markets, what combination is more attractive than that? SIRD strong short-term trading momentum. SIS is the most practically important point. With an initial public float of less than 5% of total shares, supply and demand will be severely imbalanced. Even more critically, SpaceX will be added to indexes like the Nasdaq 100 within 15 days of listing, expected to attract about $35 billion in passive fund inflows. What does this mean? In the short term, the stock price may not be driven by fundamentals, but by index funds that must buy and speculative money racing to get in. A sharp rally similar to Tesla's early listing days is entirely possible. Having said that, you might be thinking, is this a classic get in first, ask questions later? But the real question is, do you actually know where the car is heading? Now let's flip the coin. The bear case is equally compelling, and for risk-conscious investors, perhaps more important. First, the valuation math simply doesn't add up. SpaceX is priced at 90 times sales, let that sink in. Boeing trades at 1.8 times sales, Lockheed Martin 1.6 times. Even Virgin Galactic, the poster child for speculative space stocks, trades at 12 times sales. SpaceX is 7.5 times more expensive than Virgin Galactic. Both will say, but SpaceX is different. BRS reply, if right. Bubble says that at 90 times sales, you're not buying a company, you're buying a dream and paying Manhattan real estate prices for desert land. Second, the financials are brutal. SpaceX burned $4.2 billion last quarter alone. Its debt load sits at $29 billion. The entire $62.8 billion IPO proceeds, mostly going to repay debt and fund operations, not growth. Per ES the kicker, the company has never posted an annual profit, not once in 24 years. Starter RNK was supposed to be the cash cow. Reality check, it needs 40 million subscribers to break even. Current count, 4 million, that is 10 times short. So when you buy this IPO, you're not investing in a profitable business. You're refinancing an operation that loses money on every launch, every satellite, every AI contract. CRD the lockup cliff. RAM ERZ $1.8 trillion private valuation. Airline employees, venture capitalists, institutional backers, they've been waiting years to cash out. The lockup period expires in 180 days. What happens when insiders holding billions in stock can finally sell? History is clear. PEL and IR dropped 17% post-lockup. Airbnb fell 19%. UBR crashed 35%. SpaceX has far more concentrated insider ownership. The selling pressure could be unprecedented. Fraught, the Musk key factor, and this cuts both ways. Yes, he's a visionary. He's also running 6 companies simultaneously: Tesla, XXI, New Real Inc., the Bro Income, PenY, and now SpaceX Public. How many hours does a day have? BRs point to 2022 when Musk was distracted by Twitter terror. Tesla stock lost 65% of its value. The board structure at SpaceX is essentially non-existent. Musk controls 79% of voting rights. SpaceX is a public company with checks and balances. It is a private fiefdom using public money. What happens if he pivots to Mars tomorrow and starves the RINK of capital? What if his next tweet triggers a SEC investigation? You're not buying a business, you're lending money to the most unpredictable entrepreneur on Earth. So where does this leave us? Let's step back and weigh both sides. The bulls see monopoly, AI infrastructure, and the final frontier of human expansion. The Y see a generational opportunity to own the railroads of space before anyone else even builds the tracks. The bears see 90 times sales, perpetual losses, insiders selling bonds, and a one-man risk concentration that would make any portfolio manager wake up sweating. Both H sides have valid points. Both H are telling selective truth. Per ES what neither side will tell you outright. The outcome depends entirely on your time horizon and your risk tolerance. If you're a long-term believer 10, 15, 20 years and you can stomach 50% drawdowns without losing sleep, this might genuinely be your Amazon 1997 moment. But be honest with yourself. Can you hold through a 3-year bear market while the company burns cash and competitors catch up? Most people can the Y sell at the bottom and buy at the top. If you're a short-term trader, the setup is seductive. Lim ET float index inclusion, momentum, money flowing in. A 30% pop in the first month is entirely plausible. But remember, everyone else sees the same setup. The easy money is rarely easy. When the music stops, you don't want to be the one without a chair. Per is my final take. SpaceX is undeniably a great company. It changed the aerospace forever. It might change humanity as future. But a great company and a great stock are two completely different things. The price you pay determines your return. At $1.8 trillion, the market has already priced in perfection and then some. You're not getting a discount for the risk. You're paying a premium for the story. So is this the last chance for ordinary investors or the ultimate retail trap? The honest answer, it depends on who you are, not who you think you are. Who you actually are when your position is down 40% and the headlines turn negative. The space economy arc is boarding, but before you step on, ask yourself, are you prepared for the voyage? Or are you just buying a ticket to the next bubble? The choice is yours, choose wisely. If your excitement has started to build after hearing that, please hold on. The next few minutes might make you gasp. The bears argue that the current pricing has already severely overdrawn the future, and the retail investors entering now would most likely become exit liquidity. Let's break down 3 core arguments. Firstly, the valuation is absurdly expensive. But add on the offering price, the price-to-sales ratio is nearly 90 times. Where does that level mean it's far above any company in the S&P 500? For comparison, Nvidia SPS is about 30 times, Tesla is about 8 times, and the traditional aerospace company Lockheed Martin's is less than 2 times. SWSDM, Odaran, the DRN of value at NYU, believes the fair valuation is around $1.3 trillion, a discount of about 26% from the offering price. Morningstar is even more conservative at $780 billion, a discount of more than 50%. In other words, valuation experts generally agree, if you buy in now, you'll lose at least a quarter, and possibly up to half. And that's before accounting for additional declines if market sentiment turns. Why is the valuation so expensive? Back all the optimistic expectations have already been priced in. Still, RANK needs to cover the globe. AI computing needs to challenge Nvidia. Mars colonization needs to begin in the 2030s. If any one of these falls short, the valuation bubble will burst. Second, the black hole of losses. In the first quarter of 2026, the net loss was a staggering $42 billion. Keep in mind that says 1 quarter annualized that as a $168 billion cash burn rate, and the loss structure is even more troubling. The profitable STARINK business is being continuously bled dry by rocket launches and the AI business. The XI business alone posted a quarterly operating loss of $2.5 billion. Where is XI? It is the AI company Musk started separately, which was later merged into SpaceX. Its large model, Garo K, is competing head-on with OpenAI's GPT and Google's Gemini. The problem is, this race is incredibly expensive. OpenAI burns $5 billion a year. XA's $2.5 billion quarterly loss shows it is still in a frenzied catch-up phase. Simply put, SpaceX is currently using one profitable business to feed 2 money-burning black holes, and neither of those 2 holes, rockets and AI, will likely become profitable anytime soon. STARINK is indeed making money, but its growth is slowing. The global satellite internet market is only so big. Amazon's Project T Caper and China's School 1G are catching up. How long STARINK's first mover advantage will last is a huge question mark. XRD Musk as one-man empire. XS is the structural risk that bears worry about most. Musk holds nearly 85% of the voting power, and the company has virtually no independent directors. Size structure is efficient for decision-making, but it also means corporate interests may be completely subordinated to Musk as personal will. For example, the Mars project. What is the Mars project? It is Musk's ultimate dream, but also the black hole of all black holes. Manned Mars landings, building bases, terraform or emptying the atmosphere, each of these is $1 trillion undertaking. If Musk decides to pour all of SpaceX cash flow into Mars, can minority shareholders stop him? No. You can only choose to believe or sell. In other words, if you buy SpaceX stock, you are a minority shareholder of Musk, not a partner in the company. Tate distinction doesn't matter when things are going well, but when strategic disagreements arise, it could wipe you out. The bull case rests on 3 pillars: monopoly position plus AI story plus low public float. But the bear case has 3 mountains: 90 times PS, $42 billion quarterly loss, and Musk as absolute control. However, what really makes professional institutions front and stop here? The next 3 risk signals are the ones that are truly less friendly to retail investors. Beyond the fundamentals, this IPO's transaction structure contains a few traps that are not very retail friendly. Let us unpack them one by one. Treasury P1. The main use of funds is debt repayment. Of the approximately $75 billion raised in this offering, about $62.8 billion is already earmarked to repay bridge loans and clear historical debt from XI. In other words, The money you invest is not going directly into building rockets or launching satellites, it's swilling past financial holes in the company. Hurry, we need to explain what a bridge loan is. Simply put, it's short-term, high-interest debt that the company borrowed from banks before the IPO to keep operating. The plan was always to pay it back with public shareholders' money after listing. As practice itself is not illegal, but it exposes an awkward fact. SpaceX cash flow is nowhere near as healthy as it appears on the surface. Even more delicate is the historical XI debt. How did that debt arise? It came from Musk's aggressive expansion to catch the AI wave. Now that XI has been consolidated into SpaceX, the debt belongs to SpaceX too. It's like buying one stock and as a bonus taking on the problems of another company. P2, a special lockup arrangement. SIS is the mechanism that retail investors most easily overlook, yet it has the biggest impact. Elon Musk has pledged not to sell his shares for 1 year. Some internal employee shares have no lockup period at all, they can be sold immediately upon listing. Even more noteworthy, starting in the 1st of August, 0 to 20% of total shares will be unlocked in batches. That means less than 2 months after listing, a massive wave of selling pressure will appear. Imagine in this scenario, the stock lists in early July, the price is driven up, retail investors pile in. Early August, the lockup expires and early employees and institutions begin selling heavily. Your cost basis could be 10 times higher than theirs. Who does this game structure favor? P3, a warning from historical data. Studies show that over the past 15 years, the average maximum drawdown for large cap tech IPOs in their first year of trading is as high as 55%. Meta fell 50% in its first year. UBR fell 35%, and even Tesla experienced an 80% crash. For a company as massive and established as SpaceX, the historical return in the first year after listing is often not optimistic. Why back-out expectations are so high that any earnings report falling short will trigger a sharp correction. Each of these three traps alone is enough to make anyone cautious. Combine it together plus the 90 times PS ratio and massive losses, you should understand why so many institutions are shaking their heads. We reviewed both the bull and bear arguments. Now back to the original question, SpaceX IPO opportunity or taking retail investors for a ride. I believe SpaceX is a great company, but the current IPO pricing is not necessarily a good investment. Garage does not equal good stock. This lesson has been proven time and again in the capital markets. NK of Cisco back in the day at the peak of the dot-com bubble in 2000. Cisco was the greatest networking company in the world, dominating global routers and switches. Its stock rose to $80 with a market cap over $550 billion, briefly becoming the most valuable company in the world. Then what happened? The bubble burst. The stock fell to $8 and has recovered in 20 years. The company was still the same company, but the timing of entry was a disaster. Think of Alibaba when it went public in 2014. It was seen as China's Amazon. The IPO price was $68 and it closed the first day at $93. How many people thought they were buying the future? Yet for the next 7 years, the stock spent most of its time below the IPO price. It was until the 2020 pandemic e-commerce boom that it truly broke out. CV in years. How many 7 years does a person have? Will SpaceX repeat the same fate? No one knows, but history tells us that great companies are often accompanied by great bubbles. Buying at the peak of a bubble, even if the company ultimately succeeds, can mean your investment fails. So my advice falls into 2 categories. If you are a high-risk speculator, you can focus on trading opportunities in the early days after listing. Low public float plus passive index fund buying could drive sharp short-term gains. But you must keep a close eye on the late July, early August lockup expiration and take profits in time. Remember, this is trading, not investing. Set your stop loss. Get out when you hit your target, don't get attached. If you are a prudent investor, I suggest watching more and acting less, stay on the sidelines. SpaceX's current stock price has too many options and dreams about the future baked in. Waiting for post-IPO earnings reports to verify results, or looking for entry opportunities after a significant pullback due to large-scale lockup expirations may be the safer choice. SPECACALE wait for 3 signals. First, whether StarLink user growth continues. Second, whether the AI computing business can generate meaningful revenue. Third, whether rocket launch costs continue to fall. If all 3 are validated and the valuation bubble has been digested, then consider long-term allocation. There's no rush. Fin or why I want to leave you with one sentence. SpaceX sentence has helped me avoid countless pitfalls in my more than a decade of investing. Not losing money is more important than missing out on an opportunity. The SpaceX IPO may be the most hyped investment event of 2026. But the hype belongs to others. The money is yours before you press the buy button. Ask yourself clearly, are you investing in the future or are you paying for someone else's dream? Do you plan to use spare cash to bet on a high volatility opportunity? Or are you more inclined to look for certainty in long-term holdings? Tell me your investment style, and I can help you further assess whether this time you should make a move. If you found this video helpful, remember to give it a thumbs up and subscribe. See you in the next one.